Welcome to Topic 6, Statement of Cash Flows, Part 1. Just to give you a bit of an overview of what we're going to be covering through Topic 6, we're going to go over why cash is so important to a business. It is really quite critical. We'll define cash and cash equivalents. We'll compare and contrast the roles of the three external financial reports. So that'll be our income statement, our balance sheet, and our cash flow statement. We'll discuss the three components of the cash flow statement, which includes operating, investing, and financing activities. We'll have a look at identifying non-cash transactions. We'll prepare a simple statement of cash flows from a list of items, and also we'll have a look at interpreting a statement of cash flows. So this topic, Topic 6, is the last of the financial accounting topics in this course. So hope you do enjoy the last of financial accounting. So moving on now to Part 1. So what we're going to focus on in this video is why cash is so important to a business. How do we define cash? How do we define cash equivalents? And then we'll compare and contrast the roles of those three external financial reports. So firstly, why is cash so important? Well, we kind of need to pay bills. Life gets a little bit hard if we can't pay our bills. We can't buy goods. We can't pay people to do things. We can't pay employees. So we really do need cash. So a really common cause of business failure is that businesses don't have enough cash to pay their bills. Sure, maybe profit looks awesome, but if you don't have the cash, you can't buy things and you really can't continue to function. So cash is the most important asset of a business, and it's one that investors and analysts do watch very closely. So because our balance sheet and our income statement are prepared using accrual accounting, they don't really give you much information about a firm's cash position. So really, all you can see on a balance sheet is the cash at bank account, but that's about it. That doesn't really give us much information about what's actually happening with the cash in a business. So our balance sheet and income statement, what they show us are changes in wealth. They don't show us anything about changes in cash. So a statement of cash flow is needed because it shows us the firm's liquidity. In other words, it shows us changes in the firm's cash flows. Now putting some definitions around cash and cash equivalents. So examples of cash include, and cash equivalents include your cash at bank overdrafts, short-term money market deposits, bank bills. Cash represents cash on hand. It can be cash at bank, and it can also be demand deposits. So what we mean by demand deposits, at your bank account. Okay, so you have a bank account, you deposit money into your bank account, and then you can demand that money back, as in you go and withdraw it from the bank whenever you wish. So it's on demand. So cash equivalents represent our short-term, highly liquid investments that can readily be converted into a fixed amount of cash. Looking now to the roles of our three external financial reports. We have our balance sheet. So we know with our balance sheet, that tells us all about financial position at that single point in time. So it tells us about our assets, our liabilities, and our owner's equity accounts. And importantly, it's based on accrual accounting, okay, accrual transactions. So revenues earned matched with expenses incurred. Looking at our income statement now, our income statement measures financial performance over a period of time. So quite different to the balance sheet. So the balance sheet, single point in time, your income statement is over a period of time. So our income statement also presents only our revenues and our expenses. So revenues earned less expenses incurred, regardless of whether cash has changed hands or not. So again, we're coming back to accrual accounting. Cash flow statement. It's all about cash. So cash, cash, cash. You don't want to know about anything that is not cash when you are dealing with this financial statement. So all cash receipts and all cash payments for a period of time. It also includes all types of accounts, your assets, your liabilities, your owner's equity, your revenue, and your expense accounts. So it's dealing with the whole lot. And that's also why this particular topic is positioned right at the end of the financial accounting component, because it's really a culmination of everything that you've been covering up to this point. With your cash flow statement, the key thing, and it can be a slipping point for students, is that all you want to know about is cash, not accrual. So if cash has changed hands, so if we have received money or if we have paid out money, we want to know about it for this statement. If cash has not changed hands or cash just plain out isn't involved, we don't want to know about it. Get it away. With our cash flow statement, we can break it down, or we classify it into three main sections, and that's operating activities. So our operating activities include your income statement, revenues and expenses, and from our balance sheet, it includes current assets and current liabilities. So it is super important as well. It will make your life so much easier if you can remember these classifications, or the way the accounts are matched up with each of these categories. So your operating activities, revenues, expenses, current assets, current liabilities. They're the items that are going to go into this classification, or the cash side of it, I should say. Investing activities. So your investing activities include your non-current assets in the balance sheet, and that's it. So you only want to know where cash is involved with the non-current asset for your investing activities. For financing activities, here we want non-current liabilities and equity items. That's it. So where cash is relating to non-current liabilities and equity, they go here in the financing activities part of a cash flow statement. So here, just to show you an example of a cash flow statement, you can see you've got your three sections clearly outlined. So we start with our operating activities, then we move down to our investing activities, finishing off with financing activities. So at the very bottom there, you'll see that we do determine if we've had a net increase or a net decrease in cash and cash equivalents held. So that's derived from taking the totals from each of our three categories, adding them together, and if we have a positive figure overall, we have an increase in cash. If we have a negative figure overall, then we have a decrease in cash. From there, we display our cash and cash equivalents at the beginning of the year, and then we add that figure onto our cash increase or decrease to derive our cash and cash equivalents figure at the end of the year. With that figure at the very bottom of the cash flow statement, you then cross-check that figure with your ending cash balance on your balance sheet. So it acts like a bit of a check figure. Okay, if it matches up, we've got the same figure because we should be getting the same figure. If we've got the same figure, then we can say, yeah, we've done it right. Awesome, this is great, tick the box. If it doesn't match, then it's like, oh, okay, we got to go back, check your classifications, check your calculations, make sure we've got everything in the right spot, make sure we didn't hit some buttons on the calculator an extra bonus time, and make sure we've got everything correct. Okay, so there's just a nice introduction to cash flow statements and the sections we're going to be working with, as well as the role of cash and cash flow statements. So in our next video, we're going to go into each of these three components in a bit more detail for you.